All right, guys. Well, great to see everyone here today. Thank you all for joining. We're excited to be kicking off our product webinar series. We wanted to start off with no DSCR and bridge loans, but we've got a few lined up for the rest of the quarter here. We'll be doing line of credit next week or next month, and then we'll do term loans in June. So be sure to tune into those as well. One of the reasons why we wanted to kick it off with no DSCR and bridge loans is because these two loan products are just very popular right now. We're seeing a lot of success with them with our partners. The borrowers love them. They close quickly. And so we feel like it's a great way to kick off this webinar series. You probably know me by now. If you don't, my name is Craig Blodgett. I am your partner advocate here at Loanspark. My role is to support you, to ensure that our partnership is successful, provide product updates, education, deal updates, all that good stuff. So love working with you guys. And as you know, you can contact me at any time if you have any questions or any deal scenarios I can help. So there's my contact info if you don't have it already. You can also find that in my signature block, and feel free to ask questions away during the meeting. I'll also open up the floor to questions after we get through the content. And if you'd like to book time with me, my Calendly link is there as well. Happy to take this to a one-on-one setting and discuss scenarios with you. By now, you probably realize that we work with all types of your borrowers, right? Everything from independent real estate investors, small business owners, W-2 employees, and self-employed entrepreneurs. And right now, we're seeing a lot of small business owners as well as independent parties looking to get into the real estate space. And no DSCR loans and bridge loans are a great way for them to be able to do that. So with no DSCR loans, I'd first like to explain what DSCR is. DSCR is debt service coverage ratio. It's a calculation done by underwriters and lenders to determine if an underlying property can service the loan payments with its rent. In a nutshell, debt service coverage ratio, or DSCR, is an indicator of the cash flow of the property relative to the mortgage and operating expenses. And you can think of it as a way of comparing how much money the property is bringing in versus costing to the borrower. So we do offer all types of loan products. We offer DSCR loans as well. But in the case that we encounter a borrower who's looking to acquire a property that doesn't cash flow yet, no DSCR loans are great to help them accomplish that. We can do them on commercial and residential properties. So the main difference there is that a commercial would be any retail, office, warehouse space, anything like that, any place a business is operating out of. As well as in some cases multifamily, so 5 units or more. Residential, especially single family residential, would be any dwelling with 1 to 4 units that's being used for investment purposes, so non-owner occupied residential. Some of the benefits of this DSCR loan are the no debt service requirements, but also the fast closing. So we can close inside of 21 days with this program. We can offer loan amounts up to $1 million, $750,000 max for commercial properties, and then $500,000 for a cash out refinance. We can provide up to 70% LTV on the commercial side, LTV meaning loan to value, and value being defined as the lesser of the purchase price or appraised value. We can offer 85% or up to 85% on the residential side. So high leverage is giving that it allows a borrower to get into a property that doesn't even cash flow yet. The borrower has an option to buy down rates and prepayment penalties with this program. That would be beneficial in the scenario where a borrower is maybe looking to acquire a property now with expectations that rates may go lower in the future, or some other event where they would want to either sell the property or refinance into something else. So that way they can buy down that prepayment penalty up front and not be hit with that prepayment penalty when they're looking to exit the loan. It's a simple application process, and we can also allow for a seller second. Seller second being defined as a scenario where a seller maybe has a relationship with the borrower, and they're willing to finance a portion of the property. So a lot of times when we encounter seller second scenarios, the seller offers more favorable financing terms than, say, a lender or a financial institution. So this will allow them to take advantage of those favorable terms, while also giving the seller an opportunity to get the deal done quickly. We're able to work with first-time and foreign investors as well. And so you can see that the pros really outweigh the cons. The only situations really where this may not be the best fit for a borrower is in a commercial property case where it's rural. Or if it's a full-service restaurant, the reason being, in the event of a default or something like that, it would be difficult to repurpose, say, a hibachi restaurant into an Olive Garden. Gas stations have environmental concerns that make them unattractive, and then mobile home parks hold most of their value in the land, so it wouldn't be a great no DSCR loan fit. Other reasons why a borrower may go with a DSCR or no DSCR loan is when they're buying a property that doesn't cash flow to hold. Maybe they plan on raising rents down the road, or it's vacant, but they don't want to use a bridge loan. Perhaps a borrower is looking to get into a property with light documentation. These programs often don't require tax returns, so that may be attractive to them. Also, lots of first-time investors encounter challenges when trying to get into a commercial property, so this could be a great way to get their foot in the door. I'd like to go through a couple of scenarios that we've closed recently and provide some context on where these programs are very strong for borrowers. Recently, we closed a retail property in San Diego, and the loan amount was $885,000. We provided a 67% LTV and had this done in 20 days. That customer found a great property off market, but needed to capitalize on the opportunity with a quick closing. Within 24 hours of submitting the lead, a term sheet was issued, and the appraisal was paid for shortly after. Funds were issued 20 days from the lead submission, and the customer was absolutely thrilled with how quickly we closed the loan for them. Another property we closed recently was a single-family residence in Cleveland. The loan amount on this one was $407,000, and we got it done at a 70% loan to value. It took 23 days to close, and that was a first-time investor. That customer actually had served in basically 2 decades in law enforcement and wanted to find a rental property in his hometown of Cleveland. He wanted a fast closing speed with low documentation, and even though the property did not service the debt with the lease payments of the current tenant, we were still able to issue terms within 48 hours and close just outside of 3 weeks. Some of the documentation requirements that we'll be looking for these types of loans. Documentation requirements we would be looking for will be application, a purchase and sale agreement if it's a purchase, or if it's in the case of a refinance, we'll be looking for a payoff letter and verification of mortgage. We'll be doing a credit report and an appraisal, and we'll look for entity documents and insurance as well. 2 things to keep in mind. 1, this list could vary once we get to the underwriting stage, but in general, this is a great starting place. Number 2 thing is that as a partner of Loanspark, right, we're looking to take this off of your plate. We will work with the borrower to collect all of these documents, and we'll guide them through the process. But if you happen to have a file or happen to have them on a phone call and they're asking what to expect, these are good requirements that you can convey to them. Okay. If not, feel free to bring it up at the end, or like I said at the beginning, you can email me, text me, or call me with any other questions you think of later on. So bridge loans are another program that we're seeing a ton of traction with our borrowers and our partners. A bridge loan is used to acquire a property before it's stabilized. It'll be a short-term loan, 6 to 36 months, with interest-only payments. It can be used for a single-family investment property, a multifamily investment property, or even a commercial property. The idea is that it allows a borrower to get into a property with low interest-only payments until that property can be refinanced into a longer-term permanent loan. Some of the reasons why a borrower may be looking for a bridge loan is if they're looking to purchase a property and then do value add or maybe light rehab to the property to increase its value or the rents that it would be receiving. Or maybe they're looking to close on a property quickly before the seller lists it on the market. Maybe they need more time to secure permanent financing, or they're waiting for rates to come down. And then also they could be looking at other things like credit score, cash flow before refinancing into permanent financing. Those are all great use cases for our bridge loan program. Some of the benefits of this bridge loan program are that we can offer loan amounts up to $20 million, and we can still close within 21 days. All property types are allowed in most cases, and it's still a simple application process, typically with no tax returns required. Due to the structure of the bridge loan, it would be interest-only payments and short term, which gives them a chance to make low payments through that term and allows them an opportunity to exit at the end of the term or during that term. We can work with first-time and foreign investors on this program, and we're seeing a lot of great use cases here with this. The only con that we really encounter here on this program is that typically we see higher origination costs. But again, because the borrower is going to have so much of an emphasis on the exit plan, a lot of times that's going to be worked into their exit plan as well. So emphasis on the exit plan here. We're looking for borrowers who have a strong idea of how they're going to get out of the loan, how they're going to refinance, or whether they'll be selling or refinancing the property in the future. So a couple scenarios that we have here that we closed recently. We closed a 6-unit multifamily property in Houston for $1.81 million. It was at a 62% loan to value over an 18-month term. We closed it in 17 days, and this customer was approaching maturity on a 1-year bridge and was unable to extend with the current lender. Some of the units were vacant, and they intended to raise rents. So rather than refinance into a permanent loan at lower rents, they elected to take an 18-month bridge in order to allow time to find their new, higher-paying tenants, and we closed it very quickly for the borrower. Once the property is stabilized and their property can cash flow or meet DSCR requirements, they'll be able to refinance into a permanent loan with very, very competitive terms. Another property we closed recently with a bridge loan was an industrial warehouse in Seattle. It was an owner-occupied property, and the loan amount was $3.5 million. We closed it at 68% loan to value, and the term is 12 months. This loan closed in 19 days. And the customer was an owner-operator of a local roofing company and had recently outgrown his smaller warehouse where he'd been operating for the last decade. With ambitions to grow the company and an opportunity to purchase a larger warehouse from a colleague, actually, he needed a loan that could close quickly and allow him to spend some of his own capital customizing the property to his business needs. While the permanent financing option may have been available to him, the interest-only payments and quick closing of the bridge option allowed him to close quickly on the property before it was listed on the market by the seller and manage payments while he scaled to his new facility. Documentation requirements on our bridge loan program are pretty similar to the no DSCR loan program. We'll be looking for an application, purchase and sale agreement, or payoff letter, depending on whether it's a purchase or refinance, signed leases, if DSCR is being considered, as well as credit report, appraisal, and entity documents. Again, these are not needed up front. We will work with the borrower to get these documents in, but if you happen to have a package on hand, you can definitely provide this to expedite the process. So I hope this information and those use cases were helpful for you guys. I'd like to